Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. On this weekend show, we have a lot to talk about in terms of some volatility and market weakness to start the month of September. It was a shortened trading week, but boy, oh boy, we saw volumes tick up and we saw traders clearly come back to their trading stations and move these markets again, almost with that underlying defensive tone or maybe just more nervous tone that we saw from the investors. Just as a note, please be sure to go back through our website, kereport.com, and podcast or YouTube channel. Just search the KE Report to listen to all our daily editorials and company updates, which this week, a lot more companies came back to their desks and issued news, getting ready for some upcoming resource conferences. First half of this show, we're going to be focusing more broad market. Second half of the show, going into the resource sector, but we are talking with two more high-level guests here that really are just trying to make their clients money and make the most sense out of these markets as they can. We're kicking off the show with Mike Larson, editor-in-chief at Money Show. Mike, last time we had you on the show, look, you have been along the narrative of be bold in these markets, but you had an asterisk last time we chatted that was be bold, except in September. So far, that seems to be the case. Mike, how is this continuing, in your eyes, the rest of September?
Yeah, I probably could have been a little more explicit. I think I might have had that except in September in footnotes instead of on the main page. So, my mea culpa on that one. But I would say, look, I think it's a well-known fact that markets, historically speaking, don't tend to do very well in September. I mean, there's some good data, from a couple of our Money Show speakers, Ed Yardeni, Sam Stovall, CFRA Research, a couple of them I'd cite. They note that historically it is a weak month for the market. I don't know kind of what drives that other than it just happens to be one of those seasonal things that you see. But we're kind of living up to that already, right? We've seen a lousy start to the month. We had in August, obviously, some volatility where we had a big drop, gained it all back. But now we're into more of that choppy environment. I think it all boils down to people trying to figure out that there's a thin line between hard and soft landing, right? I mean, I think that's kind of what the market's wrestling with here. Did the Fed screw up by not getting the process started of cutting rates? Arguably, I said it back then, and I think it still holds true. I think the Fed, quote unquote, should have cut rates 25 bips in July. I also said the Fed, quote unquote, would not cut rates. It was one of those things they didn't have the cover for. They weren't ready to do it. Well, they probably should have. But then again, I'm not sitting around that table in Washington, D.C. So my opinion is just an opinion and is not something that drives actual activity. With that said, I think we're in this situation where, with the Fed meeting coming up later in September, I believe, again, we're speaking before we have the NFP, the non-farm payrolls number, but we've gotten data this week already. The JOLTS data on the jobs market, some of the other data out there that we've gotten over the last several weeks, whether it's inflation, whether it's jobs, whether it's, other things, consumer confidence and business spending and so on. It all is pointing to an economy that is cooling. I don't think it's pointing to a recessionary economy, but it is an economy that's weakening enough that the Fed should be cutting. And I wouldn't be surprised whatsoever if the Fed ends up going 50 in September. Again, the data to me is pointing that they should do that. And unlike in July, where I said they wouldn't actually cut 25, I would lean towards them cutting 50 later this month. And I would point out also, of course, you've got other central banks that are already on the move. Just this week, we saw the Bank of Canada cut interest rates for the third time in 3 consecutive meetings. I'm going to be up at the Money Show in Toronto next week, Friday and Saturday, the 13th and 14th. And one of the big things our speakers are going to be talking about is, hey, the Fed is about to cut. The Bank of Canada has already been cutting. It's been joined by some central banks overseas. And arguably, you could say the Fed is bringing up the rear of this train, not leading the charge. So it's going to be interesting to see how things shake out. But that's kind of what I still see here. I think this is more seasonal and more just wishy-washiness over soft versus hard landing. I think that the Fed, might have missed its mark a little bit. And instead of being wildly behind the curve, I think they're just a little behind the curve, and they can play a game of catch-up. And I think the markets can handle that once we get through the next, month and a half.
Yes, Mike, behind the curve. That statement was coined because the Fed is perpetually behind the curve, whether it's on the tightening side or the loosening side. And so, yeah, maybe room for a little catch up doing a 50 basis point instead of a 25 at the September meeting. Just curious if you think the markets have already priced all this in, because we heard for the last year and a half that we were anticipating these cuts. Markets and commodities together all kind of have anticipated that this is going to be a cycle of cuts and loosening, not just a one-off event. And so they think, okay, more easy money, that's good for the markets. But at this point, a lot of that seems to be priced in. And historically, when the Fed starts a rate cutting cycle, it's actually negative for the markets. It actually has preceded many market sell-offs. How are you reading that dynamic?
Yeah, it is kind of tricky. I mean, we're seeing, for example, in the U.S., the 2-year, 10-year Treasury spread, this measure of the yield curve, as negative as it was for I think 26 months, if memory serves, is now starting to flirt with flipping positive. Historically, when the yield curve has gone from inverted to uninverted, that has corresponded with some times when you're either on the border of recession and or market weakness or close to it. So some people are worried. That said, eventually you have to uninvert, and you can uninvert in a way that's not necessarily terrible for the economy if short-term rates move down quickly or if the Fed kind of gets back caught up with the curve, for lack of a better expression. I still am relatively optimistic that's going to happen. If you look at the forward path of the rate futures market and what's kind of priced in, I mean, yeah, there's cuts through the end of this year. There's more cuts in the first half of 25. And they kind of have the market priced, the Fed funds rate priced, instead of being here in the low to mid fives, dropping down to the low to mid threes over the course of the next year. I don't think that's unrealistic. I think this is an economy where inflation has come down. The Fed should have already been moving. Growth is cooling, in my opinion, not recessing. And in that environment, if you don't get nominal rates lower, real rates go up, your policy gets tighter, which doesn't make sense for this phase of the economic cycle. So I think the Fed should be moving. It will be moving. And as far as markets pricing things in, again, yes, we have a soft landing environment, generally speaking, priced in, even with the very recent volatility in September. I mean, obviously, before this happened, you had S&P and NASDAQ up 18% year to date, Dow up about 10, 11%, and Canada, TSX was up about 10, 11% year to date. I mean, those are kind of pricing in a no credit crisis, soft landing-ish environment. And I still believe that's the case. If we do get more turbulence, if we do see credit markets start to come unglued, if some of these things that I think are just basically background sicknesses that can be handled with long-term medication versus acute problems, i.e. the commercial real estate losses people have talked about and so on, if all that comes to pass, we'll be fine. We'll just probably be in for a lousy 4 to 6 weeks here. Again, but I do think that, and I do tend to agree that we're going to see some rockiness here. I think that's going to be the message I've already kind of and from some of the talks I've had with people that are speaking at our Orlando event or in Toronto, that's kind of what they're looking for. And the people that are telling you that aren't these sort of Johnny-come-latelys that see 2 days of lousy market action and say, oh, gee, now the market's going to be tough. It's people that have been right as rain for the last 18 months saying the market's going to be strong. So I tend to weight the opinions of those people who have been accurate for some time. And I think that it's fair to say there is some nervousness about this period, and I think it's justified.
Yeah, I focus on those people more as well, Mike. But in all fairness, you are one of those people because you were relaying the message on the downside when the markets were correcting about that 2022 time frame. And then you flipped as the markets moved higher, and it has been a strong market for over 2 years now, about 2 years actually. Look, we need to understand that whether it's 25 basis points or 50 basis points, that in the whole scheme of things is not much when you consider that the start of 2022 rates were at practically zero, and then they went to over 5% in about a year and a half. It's one thing I've noticed in Canada too. We're 3 rate cuts in now. It hasn't sparked the home market in the sense that some people think, because what I'm hearing is people are saying, well, we're in a cycle here. Why would I lock in rates now if they're going to keep going lower? How does that psychology play into investors' minds when, yes, we're starting rate cuts, but there are probably a lot more coming?
Yeah, I mean, you're well aware the mortgage market in particular works differently and is priced differently in Canada versus the US, just given the prevalence of very long-term financing here, 30-year mortgages, fixed mortgages being much more common versus variable shorter term in Canada. I think that's one of the reasons, obviously, our economy is less sensitive to rate changes, and especially in this cycle, because let's be honest, I'm one of them. I'm one of the people who refinanced into a 30-year mortgage at 3.25 back before rates shot up. And then in the U.S., a 30-year fixed went as high as about 7.25, I think, at the peak. And now it's maybe back down to six, high fives, or low sixes, excuse me. And that, right, what am I going to do? Oh, shoot, you're going to have to pry this mortgage out of my cold, dead hands, right? It's one of those things that a lot of Americans are locked into low rate financing. And that's why the market, housing market in particular, has been somewhat stuck. I think that one of the speakers I was talking to in Canada had pointed out things like condos, pre-construction, given price declines and issues in some of the big cities, that part of the market's probably going to stink for a while. At the same time, some of the not so expensive single family type properties, other non-core markets, kind of what people are looking at to own for the long term versus speculate in for gains, those might be in slightly better shape, and especially as rates come down. So that's kind of what people are looking for that I've spoken to. I think in the U.S., gradually things will come unstuck. And I think you're already seeing that in commercial real estate. I mean, one of the reasons why REITs in the U.S., they were lousy performers for 18 months. But lo and behold, look at what's one of the strongest market sectors in the last 8 weeks. It's REITs. And I think that's logical. There's some data out there suggesting that the gulf between the unrealistic sellers in commercial real estate that have been sitting on these properties, they're valuing at 100 million that are really worth 80, 70, 60 million these days, are now saying, I'm going to eat some of these losses. I'm just going to move on. I'm sick of holding on to this. And the rollover in financing rates is allowing buyers to say, you know what, these sort of vulture buyers or cheap buyers are coming out there out of the woodwork and starting to scoop things up. So you're getting that market unstuck. I think it's a very gradual process. We all know from the last housing cycle on the residential side, this process takes years. It's not like stocks, which move very quickly in short periods of time. Real estate moves very slowly in long periods of time. But the process, I think, is underway, and lower rates, all else being equal, are going to be beneficial for that sort of healing process.
Well, Mike, just to that point that it's a long-term process, not an event, and that as these rates start coming down, it's going to help definitely with not just the home, but auto industry and anybody, a small business that needs to get a loan, getting a little bit lower rates. But we've talked a lot about in the past that it was also a process of how businesses and consumers would be hurt over time because not everybody's rates rolled over at the same time on their loans. So is it possible that the rates still being quite a bit higher than they were, like when you were talking about getting home rates at 3%, a lot of people have had their stuff roll over in the last 6 months or a year, and they're still going to have it rolling over in the next year or so. Could we still see pain from the higher for longer rates because it's not like they're back down to the levels they were a couple of years ago?
Yeah, I mean, again, I don't know if we'll ever see, for ever is a long-term word, but I don't know how long it'll take to see the kinds of rates we saw at the depths of that sort of post-COVID environment where everything was extremely, extremely low. So yeah, I don't think that's going to happen anytime soon, but I do think what that will mean is, yeah, we went from in the U.S., again, if I use the 30-year fixed mortgage as a benchmark, we went from the absolute low around 2.5 to 7.25. We're probably back around 6. So maybe we get to 5-ish as a result of the Fed cutting, maybe if you're lucky, high 4s. And that's about it, because you know that even if the Fed goes low, you still have a rate premium, especially as the yield curve re-steepens on top of long-term rates over short-term rates. You'll tend to see some resistance to mortgage rates falling too low. So I don't think that you're going to see this hyperactive environment. You're just going to get back to more of a balanced environment. And I think one other thing I'd point out is you really didn't have the same stupid financing stuff going on in this housing cycle that you did in the last one, where it was, clearly just absolute reckless. It wasn't just low rates; it was absolute reckless lending policy. This time around, you got the low rates, but you didn't have every Tom, Dick, and Harry getting a loan, not justifying or not recording their income or not having their credit score checked and this, that, and the other. So I think some of the ingredients, and you didn't also have the wildly speculative building going on. So I think that the sort of healing process is going to take part differently and not take as long this time around that you had in the last cycle, where it was clearly a housing-focused bust in the markets and the economy.
Well, and that's the thing, right? Is there a glaring sector out there where you see it potentially having that bust, that contagion impact to all the markets?
Yeah. Again, we haven't seen it for some time. I think if it was going to happen, I think it already would. I would argue that what you saw, and to some degree, as a matter of fact, I would argue that what you saw with the banks that started failing in 2023, with the tighter lending standards we saw in commercial real estate and some of the Fed data on that back then, we've already had it. I mean, if you look at the Fed's own data, the last couple of quarters, their bank lending data, where they go out and survey banks and say, are you getting tighter or looser with your loans when it comes to commercial property, when it comes to credit cards, when it comes to auto loans and all that, the peak tightening of that was 3 quarters ago. It's been loosening the last couple of quarters. So the Fed's own data suggests lenders are getting less strict, even as the news media is still saying it's a disaster. Data from earlier this year suggested that those active in the real estate market, after being basically sitting on their hands and fighting and not taking losses and not looking to deploy capital for 2 years, have started to change their attitudes in Q1 of this year. So all the data suggests that crisis has passed its peak crisis point. I'm going to be wrong about that if all of a sudden we get some huge credit seize up, we get big worries about a hard landing, we get the Fed being way behind the curve and all of that, and getting this market turmoil going from being a seasonal thing to a wide, broadly based credit crunch. I don't think that's going to happen. I suppose that's one of the scenarios that's possible out there.
Well, Mike, what does all this mean for the bond market and the U.S. dollar? Because they're so interest rate driven and everything is based on the U.S. economy and the health and the outlook. If we are getting into a contractionary period, maybe not a recession, but maybe just a slowdown, what happens to the greenback and what happens to bonds? Do they start acting like a safe haven again, or are they something that people are still going to be avoiding?
Yeah, it's funny you mentioned. I mean, back in June, I wrote a chart of the week column for moneyshow.com in our newsletter. And I said, you know what? I want to buy bonds here. I think that we're done with this bear market. TLT, I didn't look at it today, but I think up from that point in just 2 months is up about 10% when you include yield and capital appreciation. I think bonds are finally a good buy, not good buy as in wave goodbye, but a good purchase, a good buy. As you guys know, I've liked gold for a long time now. I think that it really should turn on the jets moving forward. It's already beating every major asset class year-to-date performance-wise. I accept crypto if you want to include Bitcoin in that. But I think that's going to continue. I think that lower rates are bullish on that. The Fed cutting cycle is bullish. I also think the dollar is going to roll over. I think we've already seen some weakness. The factors that drove dramatic U.S. dollar strength in 22 are gone. If anything, we could see a reverse process now. And we're starting to see. So that's another bullish factor for gold. I mean, I think precious metals, I think, again, they've been very strong performance. I don't see anything that changes that. If anything, I think they perform even better in the back half of this year. And I think you want your exposure there. I don't think things change next year either. As far as, again, some of these other things for equities, it might be a rough 4-6 weeks. But if I'm right and some of the smart people that I follow are right, this is probably just a speed bump versus the beginning of the end with quotes around it. I always go back to saying, look, we had a market crash in 22. Obviously in COVID, and we bounced back quickly with all the money, but we had all markets stink in 2022. From bonds to stocks, precious metals were flat. So I guess relatively speaking, they stunk less. But you had all the dot-com stuff crash. You had CRE get into a lot of trouble, and then you had the bank failures at the beginning of 2023 because of it. I mean, I just keep going back saying, look, things were pretty terrible for a while by market standpoint there. And we're only, 18, 20 months into the recovery from that. So more of a speed bump than the end of the line as far as I'm concerned.
So true, Mike. 2022, it was painful for investors almost across the board. It seemed like it was death by 1,000 cuts as the market just kept moving lower. But boy, oh boy, it bounced back, and now it's been a couple of years of pretty good action. What about commodities, though? Because this week hasn't been overly good for commodities broadly. Oil, as we're recording this, under $70 a barrel. Copper moved back down to right around $4 a pound, although it has bounced a little bit there. What's your outlook on commodities, all taking into account that continued weakness out of China?
Yeah, I mean, the growth-oriented or growth-exposed commodities, are they going to like a soft landing scenario in the U.S. with some more China weakness? No, I mean, that's not a good story, right? So I'm not surprised by what we're seeing in things like oil, things like copper. I think that, again, they've got conflicting factors pulling at them, whereas to me, the bull case for things like precious metals is much clearer across the board. So yeah, I think that you're going to see just kind of blah action in that sector. I don't think crude oil is crashing. I don't think, yes, we broke that 70 level. I don't see $50 crude in the U.S., for example. And because I think especially groups like OPEC Plus are watching this, and they're going to probably roll back some of their production cut or production re-increase talk that they have. They're probably going to give up on that. And you roll it all together, and I think it's an environment where that is again, it's not going to be something that's terrible, but it's not going to be great either. So if you're in the commodity space, I think you shade your exposure towards precious over base, and metals and other commodities. Same thing. Gold, I think, outperforms as it has been for the year.
Okay. Mike, always great chatting with you. Again, Mike Larson, editor-in-chief at Money Show. I will post a link to the Money Show website in the show notes. That's where you can learn more about all the upcoming conferences that Mike will be at, along with all the other great guests that are featured and present at those conferences. Mike, it's always great chatting with you. Thank you very much for taking time on this weekend show. We'll chat again in another couple weeks.
Thank you, Corey. Take care.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments. With Mike Larson, we jumped around to a number of different sectors. In the back half of this show, as promised, we're going to focus more on the resource sector, and it seems like we're going to be focusing a lot on gold. We are chatting right now with Bernie de Groot, Senior Investment Advisor at Canaccord Genuity Wealth Management. Now, Bernie, there were a couple articles that you sent to your email list over the last week. You're very active sending out different reports, different analyst reports that you find relevant to the resource sector. Yeah, one on maybe the more short-term negative case for gold, but overall, the longer-term outlook for gold being still very much in this bullish environment, which, in all fairness, hey, the gold price keeps doing its part. I first want to start with that short-term negative, where TD Security senior commodity strategist Daniel Galley sent out a report that showed almost extreme long positioning by macro funds in gold. He wrote that these positions are now at the highest levels recorded since the depths of the pandemic. Also, we have seen some of these positions being reached during some of the more recent highs, September 2019, July 2016. Bernie, break down this article and how you view this fund positioning being long in the precious metals.
Well, good morning, Corey, and it's great to be back on a call with you again. And it's very prescient timing here in the sense that there seems to be a lot more attention to it as we start to see the long-awaited Fed cuts start to happen. So the market tends to be forward-looking here, and we're all anticipating these cuts. And when are they coming? When are they coming? We had talked like late last 2023 where they were saying, hey, there's going to be several cuts, and then the data changes and they push it out. So it's tough to get that actual realization of the rates cutting. But now that the rates are cutting, you're starting to see more and more of the expectations coming to fruition here. And when you look at, we had a great gold call this morning with Kerry McCurry, our gold analyst at Canaccord, did a wonderful presentation with some great data. And it just goes to show you not just the funds here, but the central bank buying for the last dozens of months here has been at record levels here. You're starting to see the appreciation of the gold price in all these different currencies, virtually all the currencies. So it's coming to the realization of what the expectation was. And I think people are getting more and more excited as you're starting to see that big job provision in the States where it basically comes out that, hey, the 900,000 jobs or so that were created, well, those jobs actually weren't created when you look at the 12 months revised data where they realized that, oh, hey, those 880,000 jobs that we said were there, they actually weren't there.
Well, Bernie, considering the economic weakness that's starting to show up in some of the data, can you envision a scenario where possibly the U.S. general equity markets are maybe a bit over their skis if we are going to see a contraction in the economy? And would that help the precious metals diverge even further from general equities?
So, interesting point, Chad. And it's a couple of different things there. So, I mean, yeah, you look at a lot of these, the tech space and the broader markets, some of their multiples are looking at are at the, as you say, over the tips of their skis here. Whereas when you look at the multiples in some of these mining names, like these things are trading at very, very low multiples, especially when you start to factor in that, hey, inflation is starting to subside a touch. And if you look at the margins that these mining companies are starting to print here, they're substantial. You saw some of the Q2 numbers were phenomenal. And I think the environment for this space in terms of gold moving higher, is it going to be bumpy? It most certainly is, as we're in an election year as well in the US, and it always is bumpy. But I think the broader markets are probably, we've had a good run here. When is that going to stop? I don't know, because I don't really speak to the specifics on the S&P. But if you look at where gold is right now, it's certainly, the equities are certainly lagging the commodities. And the goring piece that we talked about before as well is like, there's never been a time historically where gold and commodities have moved and the equities have not moved. It's just a matter of, do they move simultaneously? Is there a lag? And clearly there is a lag in this instance. And then the second question becomes, when does that lag catch up? It's tough to put pins in the calendar days, guys, but clearly you can see that the equities are appreciating. Are they where people expect them to be or want them to be? No, because if you look at the 2020 gold price we had, we're still lagging a lot of those. But I think there's a lot of caution out there, and there's a lot of, I think, question marks in markets there in terms of with investors. Where do we put our money? That's the challenge I've seen.
So, Bernie, back to what Daniel Galli said here in this, as he called it, almost unanimously bullish position for gold, and even visible short positions hovering near 10-year lows. How long in your eyes can we see action like this? And it's good to be in a bull market. I guess gold investors aren't really used to that, but how do you trade around this, and how do you then carry it over to the stocks? Because it does seem like central banks, and now what Daniel Galli is saying, funds are bullish in the precious metals.
It's long overdue. The challenge you run into here, Corey, is that the gold space is a very, very small space. And if you get some, like, I can't remember what the number was, whether it's 0.5% or 1%, you'd almost see $5,000 gold, because the sector, generally speaking, is underinvested. You're going to have funds that are taking longer positions. But if you look at where it was in the last gold run, it is still lagging.
Well, let's dive into the equities a little bit further, because obviously central banks don't buy gold equities. Some of the funds could, though, but in general, there's a lot less focus even on the desks that you see at Wall Street or Bay Street as far as commodities in general, much less the gold stocks. Do you think it's a situation where passive ETF investing brings in the inflows first and then they trickle down the food chain? Or do you think it's that we do see those better margins and that brings in more analysts?
Well, it always starts at the top. So the big names move, then we go down to the mid, then we go down to the junior. So you're starting to see some M&A, and in the past, you saw almost take unders in terms of there were no premiums. But if you look at, for example, Goldfield's premium on a Cisco, which was like a 62% premium to closing and say a 55% premium to the 20-day VWAP, you're starting to see some premiums because you're starting to see the majors start to get more interest. Like the call we had earlier where Kerry was articulating that a lot of the majors have gold on their books at $1,300 an ounce because we still have, historically, they're cautious. But if you start to see a little more activity or a little more sustained price in this range, you're going to see more confidence in the majors to be able to step out and participate in the M&A game.
We have seen some of the major stocks pretty much at all-time highs. Like Nico Eagle has been on a run. There has been that percentage of large cap stocks and also some of the mid-tier miners doing very well. That money just hasn't filtered down to the juniors. Is this still all working out natural timing-wise in your eyes in terms of where the money's flowing?
Absolutely, Corey, you nailed it there. In terms of like some of these guys, like Agnico has really been executing extremely well, margins, their own internal organic growth. So it doesn't just come in with a landslide. The early stages are selective, but when we do see the full bull run, when the market wants to get into this space, you're going to see this thing gap up for sure. It's just a matter of that. Historically, that's what it's always done. So the expectation is that when people want to get into more names, but right now you're clearly starting to see the haves and have-nots, and as these corporate accounts start to build their positions or improve their stable of assets, you'll see that like IM Gold starting to, with Cote and stuff like that, things are starting to work out. So some of these bigger producers, as they bring on some of these assets like Equinox with Greenstone and stuff like that, that's a massive 400,000 ounce producer there in a safe jurisdiction in Canada. As you see these achieve commercial production and pops onto the balance sheet, you're going to see these guys get re-rated.
Well, for investors that are looking to get into the companies that could be the takeover targets, are you more animated by the development stage companies that have ounces in the ground, or some of the single asset producers that could be bolt-on projects for these mid-tiers or larger companies?
It's challenging in terms like one asset companies they're more susceptible to hiccups versus a company with multiple assets is a much safer play because they've got revenue and production coming from multiple jurisdictions / multiple mines. So that's always safer. So look, the biggest thing about mining is, guys, go scale. Like big mines have the same problems that small mines do, but the big mines have the upside that the smaller mines don't. So when you look at some of these names, like you look at like a Snowline where it's got like 6 million ounces in very early stages of drilling here, those are the unique unicorns out there. Look at Montage, for example, like again, 5 million plus ounces here. These are the assets that get the attentions of the majors. So you want to step into these bigger assets because there's not as many of them, and they're going to have way more upside, way more mine life, so that when the cycle starts to really go, it's got lots of reserves still left.
So you even mentioned something that we've been talking about is that this market is still full of the haves and the have-nots. About maybe 15, 20% of the stocks are in that haves category where they can raise money. They've done pretty well share price-wise. And then that 80+% that just haven't gotten any traction. Are you focusing your clients more on those stocks that have continued to perform fairly well?
Well, it's the same checklist that you look at, Corey, that we've done in the past in terms of like it's people, product, place, price, promotion. And mining is a really, really tough game. So when you can look at, like, the best example I give you is like look at the Lundin family, for example, with the third generation. You had Adolf, you got the late Lucas as well, and now the new generation is really coming into their own. And I mean, look at the successes they're having. Like, it's just extremely impressive what they've done. And again, like, mining is tough. So when you've got groups that have had repeat serial success stories, it's much safer to go into those names because these guys know what they're doing. They've got the financing network to be able to finance these things, and they've got experience. Because mining is not a short, easy game. It's extremely difficult, and it's just wonderful to see these success stories continue to move along. And you want to be selective. It's not the time where we're in a big bull market where the boats all get lifted by the tide coming in here. You still want to be selective because, as you commented, like, you've seen some names like the Agnicos move and what have you there, but that's not the whole sector yet.
Are you looking forward at all to some of the optionality plays that maybe didn't look as attractive at lower metals prices, but with gold at all-time highs in the mid 2500s, almost every development project on the books looks good now. Some of those could see an increase just because of a re-rating. Are you looking at that angle at all?
Shad, we have all kinds of different risk profiles for clients. So that's a very torquey risk name, but for us, we want to look at bite size. So like your investments that you write big checks into are the nice, safe names, and then just make sure with those torquey / leverage names that your bite size reflects that. And if you're a younger person that's got more of a risk profile because you've got earning years in front of you, that might be something you take more of a risk on, but just you want to be realistic about your expectations as well. So I like to have more comfort in terms of getting into these serial success stories where you've got scale. And I mean, discoveries are tough, right?
Oh, they are tough, and they now even more so cost even more money to make happen. But Bernie, the big question being here, look, we've heard from a number of guests saying it's going to be the time for the juniors. We just need gold at 2,000, 2,200, 2,400, 2,500, and then more money flows into the sector. A lot of people are comparing this run to potentially what happened back in the 70s. But the thing is, back in the 70s, even back during the run after the great financial crisis, gold went 7x. Right now, you can argue gold has gone about 2x, a little bit more than that from the lows of now almost 8 years ago. Does gold just need to keep running higher up to the $3,000, $4,000, $5,000 level to bring in that money?
Corey, I don't think we need that. I think we just need to see more sustained pricing in these levels. I think gold is going to continue to trend higher just because you look at the indebtedness in the US, you see You look at China, for example, rolling out of their US treasuries into gold. So you're starting to see a move away from the US dollar. It's like, where does it go? And if you look historically, like when you went from the Dutch Empire, to the UK Empire, then the US dollar for reserve currency, whenever you had those shifts in financial empires, there was a landing place that people were comfortable. Now, with the US dollar, there certainly seems to be an appetite to move away from it just because of the debt levels, et cetera. But where do you land? And that's a challenge. Are you going to go to the Russian ruble? There doesn't seem to be a lot of confidence there. Are you going to go to the yuan where you're pegged against the US dollars? Doesn't seem to be as much of an appetite there as well. So gold seems to be getting more and more attention because you're starting to see more and more interest. And I mean, if you look at the central bank buying from 2011 compared to historical, like when they were selling for the prior, say, 2 decades, and if you look at from 2011 to now, and again, Carrie in our chart there's got a wonderful piece on that. It's very eye-catching. Like, it's staggering the amount of gold purchases by the central banks.
Bernie, just one more on the companies. I know I asked you about the higher torque optionality plays. Let me flip the script and go to the most conservative side, the royalty model. That's a great way to get fat margins too. Some of the royalty companies have way better margins than even the producers do because of the nature of their contracts. How do you feel about the positioning of royalty companies within one's portfolio?
I mean, it's a core position for us because, as you alluded to, Shad, I mean, when you look at an inflationary environment, like the royalty streamers, they always trade at higher multiples because they don't have exposure to inflation and what have you. So they've given the checks, quote unquote, earlier on, and now they're just collecting the ounces. Well, a lot of times, like I look at one of the guys we know well, the Sandstrom guys, they made the acquisitions with Nomad and what have you. Well, if you look at where the price of gold was then versus where it is now, it's extremely accretive. And a lot of times what you run into, like, where's your vision? If you've got a vision of a higher gold price, you want to write the check sooner rather than later. And when they wrote those with the acquisition with Baseco and Nomad there, when you're looking at gold trading sub 2,000, and now you see gold at 2,500, well, look, that's a 25, 30, 40% accretion to where they had initially written the check.
So is the game then to look at these companies that have investments by major companies or by some of these major groups that have capital behind them?
I think it all depends, Corey, on your risk appetite. If you're a younger guy who really wants to have more torque and get into, say, the leveraged higher cost producers, as Shad alluded to, that might be your route. But it all depends on where you want to be, Corey. Like, I like to have exposure to some of that, but I'd rather be but with big assets, right? It's all about scale. There's that great book we talked about before by Norm Keevil on Never Rest on Your Oars, where tech was basically founded on these big assets that can withstand down cycles.
Bernie, what are your thoughts on gold stocks that also have a pretty big exposure to another metal? So gold stocks that have copper or silver, for example, do you like the diversification aspect or do you like more pure play gold stocks?
Well, Mother Nature kind of tells you what you're going to get there because it's tough to just find a pure copper play or to get the polymetallic deposit. So I just find with investors, people who are looking to get into precious metals aren't necessarily the same investors who like to step into copper. So if they happen to have both, that's great. But typically people are isolating on or dialing into the one specific, either precious or industrial or what have you. Now you've got Mark Bristow with Barrick there. He's commenting on, hey, like, we love gold and copper. And personally, I love that as well. I love the utilization of copper and the lack of replacement. You look at the whole world where we're going towards energy and the electrification of the world. It all goes through copper. You got to rewire the world, for lack of a better term. You can look at the lack of copper discovery we made. There's a good interview there with Christy from First Quantum. He says, like, the Western world doesn't seem to have the appetite to step into discovering these copper plays versus other countries like China. They're more than happy to step into it because, again, the utility they have there is so much higher, and their appetite to get into these things are so much more than the Western worlds, where the risk aversion and what have you is more common.
It's so true, though. The Western world still seems very much distracted by other sectors, other opportunities out there. But Bernie, it all sounds so positive, right? And we've heard this in the precious metals space before. We listen to precious metals commentators, those that are bullish in the sector, and they can always come up with good reasons to be bullish, especially when you point to debt levels and government and political and economic issues. But what are some of the risks that you see out there that you need to be aware of when you are managing portfolios, especially focused in commodities and precious metals?
There's so many factors to look at, Corey, in terms of where things are. But the biggest thing, like I talked about before, is that people, if you've got experienced mining people or mine creators, mine builders, they've seen a lot of these things and they know how to navigate it, or they have the financial stroke to be able to get through these things. But a lot of times the junior companies, when they come to they typically don't have the breadth to cover off, say, capital markets or geology. A lot of the junior companies just have geological familiarity, but when it comes to whether it's licensing or permitting issues or financing issues, they really don't know where to go. They end up losing the asset, quite frankly. So if you can get a good experienced team, they know to cover off and check off all the boxes so they can navigate their way through this. But again, like the earlier geology was easier, like the outcrops, the easy stuff's all been found. So when you look at the oil and gas, where you've got disruptive technology like fracking and horizontal drilling, where you can go into old formations and you can get production. If you look at mining, like all the easy stuff, quote unquote, has been found. So now you've got to deal with more overburden, et cetera. And if you look at the geopolitical profile around the world, it's challenging. Like even when you look at the US of A, there's a lot of jurisdictions that just basically are no-goes. Like you look at some of the licensing and permitting purgatories that they've been put into, it's getting more and more challenging. Like the timeline is getting almost longer, not shorter, to license and permit stuff. So when you've got groups that are able to navigate the waters, they've got their community relations in there, that's very, very important.
Well, you brought up a couple big risks there, Bernie, with the jurisdiction, the permitting, being able to navigate social issues. What about the capital markets? Because a lot of the companies have suffered because we were at a stagnant market and they've diluted out their share count for so long that even if they have a good project, even if they have a good team, it's very difficult to raise money. How are you looking at, I guess, the haves and have-nots as far as the capital markets?
Well, I think we've seen the delineation between the groups because the market has shown you, like you look at, for example, like Montage will revert back to, they were looking at raising 150 million, the upsize it to 170 million. So when you get groups who have the financial stroke, the backer, they're getting backing versus everyone's got to learn somewhere, but it's tough. So you tend to see the bigger money follows the groups who've been there, done that, and they're able to push these assets forward versus a lot of companies, they're going from one drill program to the next. A market sees they're going to need to raise money and they just don't have it. So when the market gets moving here, you're going to see a lot more participation, but we're still in the earlier stages, which as an investor, it's Goring said, hey, there's a cost to being early and you'd rather be early than late. And some people don't have that same investable horizon. Like, where do you want to be? So for ourselves, like, look, it's really tough to get timelines. So we always want to be able to hold the trade, and that's where we're at in terms of, like, if you don't have some patient money, we really don't want to see you stepping into it, because I get people saying, "Hey, Bernie, where can I park money for 6 months?" Well, if you want to park money for 6 months, I wouldn't be putting it into the mining space because we have comfort in where we expect it to go. It's just when does it get there?
Oh, isn't that the case, right? Because look, some people probably entered a few years ago and have ridden it lower and lower, but if you can time it right and you do have that longer term horizon, which unfortunately markets have shifted a little bit away from, you can make some money there. And this could be early stages. But Bernie, just to wrap it up then, as much as we say we need other investors to come into the sector, do we need more leadership from the major miners then to distribute some of the capital that they're making and support more of these projects?
I think that's just a natural evolution. When they get more confidence to say, hey, are we staying here? Because look, things are volatile, the horizons are uncertain here, but you're starting to see more and more M&A, and I think it's going to continue here because now Q2 is really good, Q3 is looking solid. So as the majors, they've all got different risk profiles. Bigger companies are more bureaucratic, it's tough to get more sign off, et cetera. But as you see more stabilization here with pricing, I think you're going to see more M&A. But I think you're going to see some of the really sharp companies who are nimble, who can move stuff, like I alluded to before with Sandstorm, when they made those acquisitions with Nomad and Baseco. The market's probably like, hey, what are you guys doing here? This is a lot of stuff to bite off. Well, if you look now, backward looking here, those were brilliant acquisitions because, again, look where the price of gold was then versus where it is now.
All right, Bernie, great chatting with you. Thanks for taking some time with us on this weekend show. Again, Bernie DeGroot, Senior Investment Advisor, Canaccord Genuity Wealth Management. It's great having you on the show, Bernie, and everyone else, thanks for tuning in. Be sure to go back through our website, kereport.com, and our podcast or YouTube channel. Just search the KE Report to listen to all our daily editorials and company updates we recorded from the week. Bernie, thank you very much for your time, everybody. Thanks for tuning in. I hope you all have a great rest of your weekend.
Thanks, guys.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.